Hello and welcome to episode 151 of Simply Tax. You know, as I think about it, there are many things that I truly enjoy about having the privilege to host a podcast about taxes. And among them is the opportunity to learn more about areas of the tax law that I don't get to encounter on the regular. Today is one of those areas, and we're taking a look at the New Markets Tax Credit Program, which is a federally funded program administered through the Community Development Financial Institutions Fund that is designed to attract private investment into distressed communities by incentivizing investors to provide outside capital in exchange for credits against their federal income tax liability. And speaking of credit, I'd like to give some to our guest today for the opportunity to sit down and learn something about an area I had little prior knowledge of prior to our conversation that can help fund meaningful and some much-needed investment in communities. And that's why I'm excited to share with you my conversation with colleague Wes Ernst on a recent visit to Chicago. Enjoy! So now, let's jump in. And again, thanks for flying here and coming back to Chicago to visit. So,
yeah, my pleasure.
Why don't we just start with the real basic, the who you are and what you do and kind of a little bit about your background.
Yeah, sure. I'm Wes Ernst. I'm a director with Forvis. I live in Cincinnati. I'm out of the Cincinnati practice unit. But interestingly enough, we sit here in Chicago, and this is where I started my career. So after I graduated from college, I actually came and worked here downtown for another accounting firm at the time. Most of my ties are Southwest Ohio, so moved back there after a couple of years. And I've been with VKD, now Forvis, ever since. When I came to Cincinnati, at the time, there was some good opportunity in the healthcare space, and I'm sort of an auditor and financial consultant by trade. So really grasped that, and the firm kind of uses that industry specialty as its go-to-market strategy. And so I spend probably 90 to 95% of my time kind of in and out of healthcare organizations year over year.
So it sounds like you're moving back from Chicago, like you said, you can be a little closer to the family and whatnot. But how was the experience living here during the time you were here?
So it was great, when you're young and fresh out of college, and especially coming from Ohio, you're not necessarily ready to move back to what I sort of think of as the three C's, Cleveland, Columbus, Cincinnati, if that's where you sort of were born and raised. And so a popular destination for many folks who grew up in that area is to come to kind of the big city here that's drivable in a weekend and just kind of has some things to offer, quite honestly, that don't exist in those areas. But, they're great places to raise families and that really well. So lots of us tend to boomerang back to that area after a little while. So it was a really good experience when I was here. It was 2007, 2008. So I'm always happy to be back.
So did you keep your like, I don't know if you're a baseball fan, but did you keep your baseball allegiances during your time in Chicago? I'm going to assume you did.
Again, born and raised in Cincinnati, so I'm sort of the long-suffering Reds and Bengals fans for many years, although I guess more recently we got a little stretch of good luck on the football side of things. That was a pretty exciting time here earlier this year, but I certainly pulled for Chicago-based sports teams while I was here. Wherever you are, your rooting interest tends to mirror that of who's around you to some extent. Yeah. So was always in favor of them coming out on top so long as they weren't playing someone from Cincinnati.
That's right. So that's kind of similar, right? Because I grew up a Giants fan, grew up outside the Bay Area. It was like, oh, well, that can kind of be allegiance as long as you're not playing the Giants.
That's right.
We're good. So I'm going to ask you one more, just kind of getting to know your question. How did you land in accounting? Like, how did you land here in Chicago, kind of working in the space that you are? What was the path that led you there?
Yeah, so you might hear this a couple times. I mean, sometimes you look back on your career and its trajectory, and you realize how much of it was maybe luck more than any grand strategy that you had put together. When I was in school, I was undecided as a major going in. I just kind of had a general sense that something in the business realm would be where I wanted to land, and that was at Miami University there in Oxford, Ohio, about an hour north of Cincinnati. And so, I kind of did the typical thing that most of those individuals do, which is you take all the introductory courses and kind of evaluate which seems to stick, which you seem to like the most. And for whatever reason, sort of unbeknownst to me, even still to this day, there was something about accounting that I really liked. I'm not sure what it was exactly, but I picked that up, declared as major, haven't really looked back ever since. I mean, I definitely appreciate sort of the underlying mechanics of how financial statements are put together. And as you learn more and more, you can kind of glean from, how businesses operate. It's amazing how often the stories that My audit clients tell me you can kind of see it fall through the financials at the same time if you kind of know how to look at them in in the right analytical way. So that's kind of how I ended up in accounting long term.
Well, I'm going to come back to how you ended up with new markets tax credits here, but let's just throw a little background first.
Sure.
Again, basic question here. What are new markets tax credits?
The New Markets Tax Credits program is a program that was created by Congress. So it's a federal program. So it's not state specific. There are states, not all of them, but there are some that run a similar kind of type of program. But what we're talking about is a federally funded program created back in 2000. And what it's designed to do is, at its core, it wants to attract private investment, private capital into low income or otherwise underserved communities, right? And so what it does is it creates an incentive, and that's kind of the tax credit incentive, whereby an investor, most of the time a bank, in exchange for contributing some equity to a project in that community, will get those tax credits that then they can put on their corporate return. So it's a way for them to reduce their corporate tax liability in exchange for investing some of that equity. It is not a permanent program at this time, so it's something that's renewed annually. If you look back kind of in the early part of the 2000s, it was roughly $1 to $2 billion in tax credit authority allocated every year. Over the last 10 years, it's been more like $3.5 to $4 billion. And then at the end of 2020, Congress actually extended it for a little bit longer than just 1 year. They extended it through 2026 at $5 billion a year. And so there's a lot of excitement about the long-term viability of the program instead of just this every single year we have to renew, this idea that, maybe there's teeth to the success of it, quite honestly, that will make it extended even beyond that at bigger dollar amounts. Who's to say whether that'll happen? We certainly don't want to, sit here and just prognosticate, but that's kind of how it works. It's administered through the CDFI fund, which is essentially an agency within the U.S. Department of Treasury. And so what they do is they have this pool every single year, and they will sort of distribute it out across the nation to special entities, which we can talk about maybe here in a little bit, that then make sure that money gets into the community, primarily for development projects, construction projects.
Break that down a little bit. So what kind of a thing would qualify, and maybe where are these areas? Maybe an example or something might be helpful here.
Yeah, no, absolutely. So again, the entire premise is to find ways to inject funding into projects and areas that otherwise would struggle to find that, right? So if you think about access to capital, it's not equally distributed, right? Public companies can issue shares, they have other debt mechanisms they can use. Well, a lot of times, nonprofits or healthcare entities don't have as many tools, so to speak, in their toolbox to put together their financing. So, good example, if a college in a rural area, a small private college, maybe in a rural area that wants to construct some sort of building on its campus that's going to have some long-term economic return for one reason or another. I mean, sometimes it's going to be hard to find ways to pay for that, right? And so the CDFI has an application process, and entities could be just you and I. We could have one of these entities, we could set up a partnership, and we could apply and essentially say something along the lines of, hey, we're really well connected in Chicago. There's a lot of sort of impoverished segments of the city that could really use some development. We think we've got some really good projects that would qualify. Hey,
what kind of projects are we talking to? What let's go with that. Our partnership, can we kind of do anything? Is it kind of within the program that gets obviously this application process has to get approved. So
that's right.
Probably not truly sky's the limit, but I mean, are they certain types of projects maybe that are favored or tend to fit under this program?
So absolutely. Not all projects are created equal, but if you think about what qualifies just kind of at a basic level, there's really two ways. One is much more common than the other, but they use census tract data. When I say they, I mean sort of CDFI and the federal government. So if you think about the way the decennial census is put together, they gather a lot of information, break it down into census tracts, that sort of become the larger groups. And each census tract is qualified for various socioeconomic metrics, right? Some of them are considered distressed or highly distressed. They could have something like an unemployment rate, which is 3 or 4 times that of sort of the national rate. Or they could have other, again, just indicators that obviously put them kind of at the lower end of, health and well-being from an economics perspective. So projects that are being built in those census tracts that qualify, and there's some specific statistics that we don't need to necessarily cover exactly, but again, low-income communities, that's kind of your main ticket, right? So geographical boundaries that is based on census tract. If you are saying, let's say, for example, I'm the United Way of Greater Chicago, I want to build a new headquarters in this particular area, which is in a qualifying census tract, you might be able to secure the tax credits. And what would make your particular project more appealing would be things like what number of jobs it might bring, right? What is the constituency that it might serve? It's sort of those kind of soft costs. And it's really important to have a compelling project in that nature because the demand for the tax credits far outstrips the supply. So if you look at sort of the 20 years of, hey, here's how much allocation was out there. Like I said, 1 to 2 billion, maybe up to 5. You can see that the applications for that funding might have been 3, 4 to 1, right? So it's not as simple as, oh, I have something that I want to construct. Can I have a slice of these? You have to compete. And so being able to tell the narrative about why your project is compelling, what level of economic activity it's going to generate, all of those things matter when it comes to coming up with a qualifying project and B, one that actually ends up with some money in hand.
So with the tax credit, how does the benefit flow to you? So like if you're the United Way, you're an exempt organization, right? How does it help you with the project and getting those dollars into play?
Right, absolutely. We haven't even really talked about that aspect of it. So well, if you take kind of just sort of your basic construction project, right? And we'll just say $10 million. That tends to be an example that I see a lot in some of the reference materials. So it's an easy number to understand. But let's say you have this $10 million project. Obviously, you have to come up with a way to pay for it, right? You've got your construction budget, and now you got to find a way to finance that. So, you can borrow, right? You could just do a traditional loan from the local bank of 10 million. But what you can also do, if you've got the right project that might qualify, is you can use the tax credit subsidy to offset some of that cost. And when I say offset, what I mean is we talked a little bit about the investors. This is the investor piece. The investors want those tax credits, right? If you think about a nonprofit, what do they need the tax credits for? They don't have any income tax liability on their 990s. For the sake of those who might want to get technical here, technically exempt organizations do potentially pay income tax on their unrelated business income, which is income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other purpose that is the basis of the organization's exemption. But by and large, and definitely for purposes of this conversation, I think it is fair to say they don't pay any income tax. The investor is the one who's injecting that additional capital into the project in exchange for credits. And in that sense, let's say the investor puts in $2 million. The United Way, or whoever is the project sponsor in that case, instead of having to come up with $10 million, suddenly you only have to come up with $8 million. So it's sort of this specialty financing mechanism that reduces your overall cost of capital, because when it's all said and done, there's this tax credit compliance period that kind of has a run out of 7 years. But if you kind of said everything in simple terms, the project sponsors, the nonprofit organizations, the healthcare organizations, the colleges and universities, the developers, whoever is kind of involved, ends up with a $10 million building that costs them $8 million out of pocket. And the tax credit sort of picks up the other piece of that.
Like construction projects, are those kind of core? I mean, are there other things that are possible with it, or is it predominantly like
It's almost entirely new building and redevelopment.
That's what, and that was sort of my experience. But I thought, hey, I got the expert here. I can run that by you.
And it's interesting. I mean, it's one of the things I've noticed as you start to understand. I mean, you can kind of eyeball as you drive around. Sometimes you can start to see projects that almost certainly would be very popular. You're looking at it and go, I wonder if that some of that came from the tax credit side.
The play is kind of with the investors, right? So what type of investors? Do you have to be a corporation? Can it be you and me? We're going to go and we're going to put the $2 million into the $10 million building, or how does that work?
Conceivably, it could be. It could be anybody that wants to use the tax credits on their return, right? But in general terms, when you look at the industry, the banks are the ones that typically are injecting most of the capital. Now, I don't know exactly what their percentage is, but U.S. Bank is really the largest player. So they're one of the biggest contributors to the ongoing economics of this. But it can be corporations too. Obviously corporations have tax liability that they want to offset if they can. So it's certainly possible for corporations to do it as well. But you see a lot of financial institutions acting as the investors, and they will bid against one another too, right? And they'll bid against one another in a way where they will use like a price per credit sort of model, right? So one bank might bid 78 cents for the tax credits that are available tied to that particular deal. Another one might bid 79 cents. Another one might bid 82, right? It kind of depends on their own internal rates of return, what they expect to get out of it. And obviously, the higher the rate that they pay for each credit available in the deal. So let's say there's $5 million worth of tax credits in the deal. That's more money that turns into the subsidy. So we talked about that $2 million. If somebody's paying a little bit more, instead of it being $2 million, that's the offset, it would be 2.2 or 2.3, and it just is a way to lessen that burden on the sponsorship organization.
You kind of use the example of a not-for-profit, but are there industries maybe that lend themselves well, or is it specific to a certain industries that you would see that this works for, or what?
It's somewhat industry agnostic. And again, because it's a federal program, so there's no sort of state or local boundaries that really matter. It's coming out nationwide. That said, not-for-profit's pretty popular as a recipient of these, as is healthcare. And then, there's some other. And if you think about it, those two industries in particular in broad terms, why are they common users? Well, if the entire premise of the program is to find ways to attract development, attract equity, attract investment in low-income communities, those two industries tend to overlap very, very well, right? I mean, nonprofit organizations, many of them have missions which would be very, very much in sync with somehow serving and helping improve low-income communities, right? And the same is true in the healthcare space, right? Where you have a lot of entities that serve racial and ethnic minorities or low-income individuals. And so they have a lot of overlap, which makes their construction projects very much sort of kind of on the inside track for some of the new markets.
We talked about some of the benefits, and maybe we haven't quite even covered all of them, obviously. But I mean, when you talk about getting a $10 million building for 8, I mean, that's a good use case right there, right? And being able to make the deals work. But are there maybe some downsides to using the program?
There are some. There's some things that if anyone is looking into it, that they should consider on the front end. And I mean, there's a couple things. First of all, it has a certain complexity to it. It takes some time and effort to navigate. It takes some time and effort to work your way through the transaction. If you're in that CFO seat and you're the one who's responsible for sort of providing all the information, I mean, it's an undertaking, to say the least. So it does have some complexity. It also can generate some significant fees, right? So sometimes I've talked to folks and they're interested in pursuing this, and then they start to see some of the costs that are associated. And when I say costs, it's really more of a reduction of the proceeds more than it is maybe an outlay, but it can kind of still shock people, particularly as it comes to, some of the legal, accounting, consulting costs. And that is because of the complexity. One, that's one of the sort of market drivers of it. It's just it's expensive because you've got to pay somebody with some pretty significant expertise. But the other thing is what I talked about in terms of sort of the supply and demand economics. There's a lot of projects out there that are all seeking this funding. And so as you attempt to enter the space, you kind of don't want to play what that market has sort of driven. I mean, it's very easy to just kind of go on to the next suitor, right? And say, well, this is kind of the way that it works. The other thing is that certain projects, you probably need a sort of a mass too. You need kind of probably $5 million in construction cost or above to really make that time and effort worthwhile. And then the other thing is it's not guaranteed. So you could be hanging your hat on, well, this is how I'm going to help pay for some of my construction, and maybe it comes through, but maybe it doesn't. I kind of liken it to buying or selling a house. So if you think about when you sell your house, it's a pretty significant personal transaction for a lot of us that we don't do very often, right? You might do it only a handful of times in, sort of your typical adult life.
Sure.
And
I mean, moving is not the most, top of my list sort of thing.
That's right.
Yeah.
That's right.
Yeah.
Absolutely. And so you kind of hired this agent to sort of help steward you through that process, right? And they kind of know all the players. They know kind of the legal documents that you need to sign. They might know banks or inspection people that can kind of help you throughout. And it has a very similar feel to it. You kind of hire a consultant to help you go through the process. And just like when you get to that close on your house and somehow there's a little bit less at the end of the docket than maybe you thought based on, whatever the pricing was, it's similar in that regard. Now, there are some checks on the costs. There's what's called the substantially all test, which is essentially that in broad terms, 85% of the funds that are in the particular transaction need to demonstrate that they're being used in the transaction. And it's exactly this reason is that this is sort of Congress recognizing, hey, we want people to use this. We recognize that it's going to take some intellectual horsepower to help get people through the deal, but we need to kind of make sure that there's not sort of egregious proceeds being kind of taken out. And that's the other downside too, just to sort of cap off that thought, which is just there are some compliance, there's some reporting, there's some effort required on the back end, even after you're sort of through the initial funding. You have to report for several years running kind of on how it's all going and things of that nature. So there's a lift there that needs to be done.
You said it's not guaranteed. Have you seen people kind of go through that and weigh those options and decide, is it going to be worth it for me to go through this process?
Oh, absolutely. I'm happy to be here today because I think awareness of it just as an option is really the first, almost step zero, right? Not step one, but step zero is just knowing that this is out there and existing. And really step one and 1A would be to engage somebody who can help, again, like that real estate agent and say, hey, all right, I think I have something out there. Can you help me kind of get from point A where it's just kind of a thought in the air and something I'm considering as part of my capital stack to actually winning these. And when I say winning these, they're actually awarded not from the government directly. So to kind of your point about the application process, the tax credits themselves, that pool is annually distributed to community development entities, or CDEs, is often how they're referred to. And they very much are the gatekeepers. They are the ones who might say, well, here's the 20 projects or so that we know about and are thinking about, we were awarded, let's say, $50 million in allocation in the latest application round. We're going to send some here, some to this project. And, consultants will not only help you get through some of the base level items, but they will also have a general wide network of those CDEs, right? Because it's federal, it doesn't necessarily matter if your tax credit allocation comes from CDE here in Chicago, or if there's a CDE who really likes what you're doing and is out of Maine. There's not really any boundaries in that sense. And so sometimes those consultants will say, as you pick up and move, okay, hey, here's people who would be interested in that type of project, because there tends to be kind of specialties, right? So certain CDEs will be really into education, particularly minority education, right? And so maybe they're based in Tulsa. And so if they hear about your project, they're going to be looking and interested. And that's what a consultant can kind of help you do. It's not dissimilar from, investment banking on the private equity side. You have an owner who kind of wants to sell their company, but is saying, well, I mean, where are the suitors? And, so you have that sort of intermediary that can say, okay, we've got a pretty good understanding of who might be interested as a buyer's list. It's very similar in concept.
All right, so let's just say that I'm that CFO. I've completed step zero because I just heard you tell me about this thing. That you're right. I mean, to your point, it's not being discussed as often and as frequently as perhaps maybe it should, because it's an option, right? All right, so you got step zero completed. You're going to get the help on figuring out, is this something that's viable? Tell me a little bit more about like the care and the feeding and watering, if you want to call it that, of these down the road, because you mentioned the compliance period and the ongoing maintenance, I guess, in that 7-year period. Tell me more about that.
We'll talk about it maybe from the accounting and reporting side is the easiest thing, because if you're in that CFO seat. So what do you have to do? Well, there's a big lift initially, right? Because you're just corralling lots of documents. Again, just like when you buy or sell your house, like in that sort of period where your house is on the market to when you actually sell it and close, there's a lot of effort required. So you've got an initial lift there. Then on top of it, typically, not always, but typically, a separate entity is frequently created to sort of house the funding and the actual cost. So you have kind of a new entity to monitor. Sometimes that entity is going to have, just ongoing insurance, ongoing tax, ongoing audit fees. And that's another piece, that special entity is often something that needs to be audited. So you got that you have to kind of handle and manage for a 7-year period. And then it just kind of adds a level of counting to your overall, just finance department, right? I mean, it's just something that you have to then keep track of and make sure that you're reporting back to your CDE that funded you, and so that they've got their arms around kind of how the project is going, how it's come out, some of those types of things. So it's got kind of a long tail. Now at the end of the 7 years, it does sort of collapse and kind of disappear. There's sort of out clauses, you might call them, call or put options is actually the way that it's structured in the deal itself. But it allows all the stakeholders who are sort of those originally invested in how it all works to kind of walk away and say, you know what, this worked exactly how it was supposed to. We're at the end of the 7-year tax credit compliance period. We all can now kind of step back, look at this and say, this went exactly how it's supposed to. It's time to kind of move on. And that 7 years is based on really what the investor's timeline is. So when we talk about that bank that put in the initial equity in exchange for tax credits, they don't necessarily get to run all those through in year one, right? They have to take the tax credits they receive and spread them out at specific percentages from year 1 to year 7. And it's that 7th year that really ends up what closes out the entire transaction.
You mentioned a little bit about the future of it. We're good through 2026, I think it is, right?
Yeah.
But it seems like, there's been this big reemphasis on the program with the additional dollars. How would that factor in if, again, say I'm that CFO that, now I'm into like step 2 or 3, maybe 4, thinking about the longevity of the program, because it takes maybe a few years, or maybe I'm a few years out on the project even. How would that weigh into my factors here?
Yeah, and that's a great question because, any annually funded program technically could disappear. If Congress doesn't support it, or doesn't enact, some sort of extension, it could be that you're sort of trying to chase down something that doesn't exist come this time next year. I would say that that's certainly a risk. That's certainly something that, anybody would want to have on their sort of calculus of the pros and cons in addition to some of the other things we talked about. But if you sort of step back and look at it overall, right, it's been around for 20 plus years now. They just extended it for 5 years at a bigger dollar amount. The other thing that is worth it is that it, generally speaking, is pretty bipartisan in its agreement on success, right? I was at a conference in DC on tax credits, and they showed a screen about here's who, in the Senate and the House have kind of signed on as support for this. And you get a lot of stars next to a lot of names, right? So it just tells you there's sort of wide sweeping agreement. And the stats sort of bear that out. You're talking about, if you think about the agency, they put out some statistics on the program. You're talking about roughly $8 of economic value created for every $1 in tax credit spend. You're talking about 830,000 jobs that have estimated to have been created via all the projects. You're talking about somewhere between 6,000 to 7,000 construction projects that have been kicked off, 200 plus million in square footage of retail, office, other space. There tends to be tacit agreement that in large part, this is kind of how it's supposed to work. This is something we can hold out, broadly speaking, as working very, very well. And so I have a hard time thinking that on my list of items that could run me off the rails in terms of pursuing this, I would put this sort of toward the bottom in terms of the risk of it disappearing.
Tell me a little bit more about that conference. I don't know, were there other themes or what else is kind of in the conversation these days with these credits in the program?
Generally speaking, it was a good update on kind of all things that are happening, and you get a sense of kind of where people are. Something like that. It's interesting you asked that question. I walked away from it more than anything feeling, I think, inspired, right? There were a lot of recipients of the funds in the audience. There were CDEs that were there who were sort of able to brag on some of their projects. And, when they talk a little bit about, some of these people get up and they kind of talk with the passion and the excitement about what they were able to do using these tax credits and how it's kind of played out. It's just kind of an inspiring place to be. Even that, I think, matters a little bit. The enthusiasm from those who have participated is really, really high. And I think that probably bears out well long term. I do want to mention it is a financing of, I don't want to say last resort, but there's something called like the but-for test. So the idea is that This is not something that's going to just cover your entire project. I want to make sure that that's clear. So we go back to the 10 million. You're not going to use new market tax credits of $10 million and come away not having to had borrow or not had to put any cash of your own into it. This is set up so that you have to kind of be able to say, look, we've got a really good idea. We think this will help this low-income community, this constituency. We've secured most of our financing. We just kind of are missing this last piece, right? But for the new markets coming in as the last piece of our puzzle, this project will not go forward, right? That's kind of the idea behind it. And so you don't want to go so far as to say that they sort of rescue what otherwise would have never happened, but that is the general sense. And so that's why I think people are so excited to talk about some of the things that they've been able to do, because it may not have been something they could have done otherwise.
Very interesting and very cool. Yeah, kind of the rewarding aspect of it.
It really is.
Now, I have to ask you, and it's because these are apples and oranges, obviously, but with the 2017 tax reform, we saw the qualified opportunity zones get created, and there is similar, census tract areas that it's focused on. Has that had any impact on maybe the supply and demand, or how has that maybe had an interaction there?
That's a terrific question, and the answer is absolutely. It does, just because of some of the basics, which is if corporate tax rates come down, how large is your appetite for tax credits, right? Or what's the correlation between investor appetite to secure tax credits if your initial liability is lower? It goes down. So when I talked about the pricing a little bit earlier on, that's kind of one of the things that maybe has been impacted by 2017. Pre-tax reform, you might have seen pricing 85 cents per credit, 86, maybe even a little bit higher. When suddenly the need to reduce corporate tax liability goes down, you saw some of the pricing come down. So there's a very direct impact between the two, between the tax reform and the tax credits. So sort of oddly enough, for some reason, there was tax legislation enacted between now and 2026 that increased rates, that it would have a sort of strangely favorable impact on NMTCs as part of a deal, because investors would be driven to secure them a little bit more than they otherwise would be.
Right, because
before.
It goes a little bit further with
That's right.
More bang for your buck on the tax side of things.
That's exactly right. That credit is worth a little bit more.
Right,
Yeah.
right.
Mhm.
It's counterintuitive, but makes a lot of sense, right?
Absolutely.
All right, so I'm going to go kind of full circle here, back to that question I kind of put off to the side, which was, how did you get involved in new markets tax credits?
Yeah, so this is when I say at the beginning, it's amazing how many things are a little bit of luck more than strategy. That's to some extent how I ended up here, right? So I'm an auditor by trade, and at this point I essentially audit healthcare organizations, but just because of their sort of overlapping models, sometimes I've spent a lot of time in not-for-profit auditing as well, and sometimes you're in the right place at the right time. In this case, I just had one client execute a new market tax credit transaction, then another, and then another. And, it's like a lot of things that are complex. If you've seen one, you're automatically the expert in the room, because just having seen one, you're ahead of the curve. And so I had to unravel kind of how it worked, and had the fortune of getting the repetition to do it. So it wasn't just that I had one client to do it and I sort of had to just know at a high level and then was able to move on. I had enough that participated that eventually, you just started having to figure out like a little bit more about what's going on. And I think I've since spent a lot more time in it and just researching it, trying to figure out kind of how to help clients, making sure clients know about it. And some of that is because what I talked about coming back from the conference. I mean, I do sort of enjoy what it has accomplished and who it helps. I mean, it's an exciting thing to kind of just think through and contemplate on the front end because of what the downstream byproduct is on the back end.
I guess with that in mind, how does Forvis help in these situations? So again, I'm not CFO, right? And I'm looking at the project and thinking about how is it all the pieces are going to come together. What role can you and the team play?
This is an accounting transaction in some fundamental way, right? I mean, yeah, it's part of your financing, but there's a lot of back end accounting. So certainly, we're there to help in terms of, hey, I don't understand what's happening. Help me walk through some of even the basic accounting entries. What is this going to mean for my balance sheet? What is this going to mean for my income statement? How do I report some of the items that I see? In addition to that, a company in every single transaction, in order to get to the sort of the final close, the final signatures, is a forecast. So, the accountants will put together kind of a sort of a forecasted sources and uses document, right? That can range from 30 pages to 100 pages, sort of depending on the complexity of that particular deal. And that is signed off by a CPA firm. So it's a compilation level, type of report and forecast. And one of the things that we've done is we've been able to build out some really sophisticated tools that will allow the preparation of that to be automated in a way that it really does a number of things that aren't present in the market right now. It's going to save some time, it's going to save some money, and it's going to reduce risk too, because anytime you take sort of the technological side and you move away from that Word, Excel model that just kind of has a way of not always working the way or quite as slickly as you think, you tend to end up with a better product. And so we've put together some tools that are powerful, quite honestly. I mean, they're very sophisticated in terms of how they can produce a forecast.
It sounds like, again, as you look at this and you talk about the complexity, having a tool to kind of help with the lift, that's got to be a good thing, right?
Absolutely.
Yeah,
absolutely. And, we've done some things to sort of build in some educational aspects of it, because that's some of the battle too, just getting up to speed and saying, understanding what it is that's happening each step of the process. We kind of want to be there alongside everybody and saying, okay, this is how you can work your way through and help them on that side of things too.
Even just your story of kind of how you found your way towards this, maybe a little bit of luck, but also you've seen people do it. You've gone through it. People have done these clearly. Like you talked about some of the statistics that were shared at the conference. It's not an insurmountable task. It takes some effort and some work, but hey, you get a good real estate agent, you can find a great place to sell yours,
That's right?
So it's kind of like that. So, all right. So I guess, maybe it's the closing thought that you would leave, listeners with just in general about this program.
Yeah, I mean, I think closing thought would just be aware of it. I've given a couple of presentations here and there about it too, and that's what I tend to close out with. Hey, you don't need to understand all the gory details of how it works after listening to this. You just need to know that it exists. And so the next time you're starting to think about some project that's going to benefit that community, know that this is on the table, right? Know that it's out there, so that, if there is a chance that you could get a qualifying project or that your project will qualify and you can secure these, it just, you have the ability to kind of create a long-term legacy, because you've reduced your borrowing, you've reduced your cash, and it allows you to do other things that, then would add benefit long-term. That's really what I try to tell folks, is just, jot it down, keep it on your list, keep it back there as something to be aware of if and when the time comes, because in the right circumstance, it could be a big success.
Well, I just get the sense here sitting with you, which is always so nice about sitting down. You just get a sense for things, right? That you're just fired up and passionate about this program and helping people understand it and figure out if it's a good fit, maybe kick the tires a little bit, so to speak. So sounds like you'd be willing to help out and at least just have a conversation, figure out if it's a fit.
Absolutely. I mean, and it feels like a call. It's almost once a week, whether that's internal Forvis person or external person who got my name somehow, some way, or heard me speak. My approach is always just, hey, let's talk. I'll tell you what I know. Tell me a little bit about what you're thinking, and I'm happy to sort of just offer up any insight I can give you. Just so that you're starting off on the right foot, right? I mean, again, back to the idea, in an era where time is a little bit at a premium for a lot of folks, just because some workforce shortages. I mean,
there is a lot coming at all of us, right?
You can just cut through and say, hey, I heard this, I'm interested, but instead of me sort of slugging through all of the needs, what are the three things that I need in any direction you can point me, that's going to really help me out. And I like to try to do that. It doesn't matter if it benefits Forvis or myself or not. It's about just kind of making sure that this is an ongoing thing nationwide.
I love that, and I would strongly encourage you to reach out to Wes. You'll find his contact info, as well as some additional resources where you can learn more about the New Markets Tax Credit, in the show notes of this episode that are available at Forvis.com/simplytax. We want to know what you think of the podcast, so please leave us a rating and review on Apple Podcasts and connect with me on social media. You'll find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The
information contained in this episode of Simply Tax is based on data available as of the date of its release. Corvus is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.